almost there. Good morning, anyway, to you.
Good morning. Happy holidays.
Happy holidays. Merry Christmas. I hope that your Christmas went well and the COVID angel passed right over your residence and kept you safe.
Yeah, I put some blood of the lamb on my doorpost.
Excellent.
So, yeah,
that's good. And it's been quite a year, hasn't it?
It has. I know that everyone is saying the same thing. Let it go. Let's hope that we don't waste another year with this. Okay, so
you betcha. Okay. All righty. I thought that this would be a good time to talk about as we move from one of the most interesting years of all time into 2021, the next year in succession that could be, in my opinion, my humble opinion, even more interesting. And I'll kind of dive into both what I see is coming up and the psychology of market traders. I wanted to talk about that a little bit this morning.
Okay.
Do you want me to just launch in here and go ahead? Okay. Yep. Spanish philosopher George Santayana is credited with the aphorism that those who fail to learn from history are doomed to repeat it. But the question for us this morning is, why do those who have learned from history, who have studied the important market tops over the centuries, still fail to get out and reverse their position at important market tops? That's what I'm going to talk a little bit about this morning. It's literally the billion-dollar question, as you can tell from my title. And I call it the billion-dollar question because Jesse Livermore in 1929 had, in fact, learned in detail from history. He studied it for decades and lived through it and understood it and correctly positioned himself short at the top of the 1929 market and made the equivalent of 1.2 billion 2020 dollars trading short that decline. So the question I want to throw out to anybody listening is, why don't we all do that? If that's what he did and he's our example, why don't we all just identify the top short and write it out and repeat his success? As it turns out, the answer to that question is the market's nearly infinite ability to deceive, because there's an enormous difference between recognizing a market top by examining historical data and living through the development of that market top. In real life, the driving forces that drive a market higher, and the fact that top calls so often turn out to be wrong as the market continues high. Right, as market continues.
How about Livermore, Don? Was he ever in his writings talk about being early, probing, looking for the top in 29 before it actually did?
He never talked about that specifically, but he talked about the fact that many traders, the very thing that I'm talking about now, many traders correctly identify a market bottom or a market top, and they start out right and they get off track. They never make the real money for psychological reasons. But yes, sure, he had those problems like all of us do.
Okay.
But my point is that markets tend to, the longer they go up, the longer they extend, the further they extend a trading top, the more people get fall into the trap of believing the four most ruinous words any market trader can ever utter. And those four words are, this time it's different.
Right.
The fact is, this time is not different, and that's my point today. If you take a look now, you are seeing, I hope, on the screen the New York Stock Exchange Composite Index for the last 30 years. Is that correct?
Yes.
Okay.
And you have all the tops designated. And you know what? A lot of people forget about, because it happened so quickly, the COVID crash. So a lot of bears, they're saying the bears have been wrong forever, but you know what? Because the crash was basically, wiped away, that was still a crash. We did have a crash. Even though if you went to sleep for a few months, you wouldn't have seen it.
Definitely. And
a lot of people are saying the bears have been wrong forever. That's not true.
I'd love for some of those critics to look back at my articles from January of 2020.
Yeah, I remember.
Yeah, good, thanks. But at any rate, that's an important point. Thank you, Dale. The chart we're looking at is showing the monthly bars of the New York Stock Exchange Composite from 1991 to 2021, 30 years, in the lower part of the chart. And in the upper part of the chart is the simple MACD. Now, that's probably the best way to identify or recognize what the trend is in the market with regard to the primary trend, the bull market or a bear market. Normally, the MACD is moving up during a bull market and then reverses and starts going down to tell us we're in a bear market. And when it and normally it does that very simply, like it did in 2007. That's the second one that I've got marked top.
Well.
And then the third one I've got marked top, it's 2015. We had the same thing. It'd been moving up and then it reversed and went down. So those are simple tops. But sometimes we have complex tops. 2000 was a perfect example of the complex top. The MACD had moving of the monthly New York Stock Exchange Composite had been moving up for years and years and years, and peaked in 1999, and then it started going down in a very, very complex pattern. And finally, the market peaked here, and you can imagine how worn out the bears were if they were using the MACD as their measure of the market trend, because it had been going down for what, a year and a half or something by the time the market finally peaked in, I think it was April of 2000 here. So this complex pattern carved out the topping process of that long bull move from actually 1982 up to 2000, before the market went into a bear market that took the NASDAQ down 79%, almost 80%, the NASDAQ composite.
.com.
Yes. Yes. Now, take a look at the current market. You think that was this was a simple top, a simple top? This was a complex top? You think this was complex? Look at the one we have now.
Yeah, definitely.
It has stretched, from late 2017 to it's still ongoing. That is one big, long mother of all tops. And my whole point is that I'm looking for the final peak in that market to occur early in 2021. Now, in the meantime, of course, Markets aren't going down. We're not short this market right now at all. In fact, we've been trading long all through the last couple of months because this topping process is still going on.
Okay.
But my point is, this is not the time for people to say this time is different. That's exactly what they are saying. That's exactly what people are tempted to say when this topping process goes on and on and on, and markets go higher and higher and higher. Don't be fooled. This is all part of a very long, complex process, as more so even than in 2000.
Yeah. We're already talking about 3-4 years of this process going on. Although during the process you were still better off buying big breaks because it's still
yes.
Well, it depends. It has become more of a two-sided market in the last 6 months than the kind that if you're shorted, it's in your face and you're down 40 S&P handles right away, like I was the day Pfizer's vaccine, the first vaccine news. I think the S&Ps were up 40, 50 handles.
Yeah.
So, okay, so go ahead, just continue.
At 7 Sentinels, we've been mostly long the market for the last several months. But my point today is this is the time to prepare yourself mentally for the fact that even though we're long the market and making money on that, this is not the time to think this is going to go on forever or this time is different. This is a time to prepare oneself mentally for what's coming in the 2020s. What I'm going to show you now is just some of this last just over 3 years, the extreme top indications that have occurred in this over this period of time. And incidentally, everything that we're talking about today is published now on the website. Excuse me. And I put the link on Twitter. So anybody can go to Twitter, find the link, and see the article that covers everything we're talking about today and a whole lot more. But in that article, I talk about a whole lot of top markers over the last 3 years. And I'm just going to touch on some of the most amazing of those indicators. And so let me just touch on those. During the 2017-2018 period, the CBOE Black Swan Index registered its highest reading in recorded history. I'm not going to go into exactly what that means. It's all in other articles that I've written. But VIX registered its lowest fear rating in recorded history several times throughout 2017. The CNN Money Greed Index hit 95 on October 5th, 2017, the highest in recorded history. The exposure of mutual funds, and this one is just amazing to me. The NAAIM, that's somebody who follows what the mutual funds are doing, exposure level for hedge funds registered its highest commitment in history in 2017 at, get this, 110% long. Of all the mutual funds that they follow, the average commitment was 110% long. In other words, they were leveraged long. Yeah. That's the highest ever reading. The investors' intelligence bullish sentiment indicators surpassed unheard of peaks of 1987. The peaks of 1987 were exceeded in 2017, as this chart shows. And people can go to this article and read it for themselves and see the details of this. And then there was a period of time at the end of 2000. 2017 when, well, actually, I think it started clear back in 2016. It did. From November 7th, 2016 to January 22nd, 2018, 303 trading days, the market never had a correction, didn't ever pull back as much as 3%. That's the longest streak of that kind in recorded history. And then there was.
You have Don. Excuse me. Do you have other visuals?
Ahead.
Other visuals along with this, because we're still staring at the same chart that.
Oh my gosh! I didn't know that. Okay,
yeah,
you're
you got to scroll.
Now?
Okay, yeah.
Oh,
it's okay.
I'm sorry. What I did was I've got it on two screens, and I thought you were looking at the other screen.
It's all right.
Okay, so here was that fear greed index at 95. Here is the 110% commitment level of the mutual funds. Here is the highest investors intelligence bullish sentiment level ever in 2017. Here is that streak of 303 days where the market didn't ever have as much as a 3% pullback, the longest such streak in history. Thank you for telling me that, Dale.
That's okay, buddy.
There was an article in Zero Hedge on August 27, 2020 that was just excellent, and it was entitled Charting the Market's Descent into Insanity. Excellent article. I recommend that people Google it and go back and read it, but here are just some of the highlights of that article. By that time, in late August of this year, it still is 2020, Apple, the valuation of Apple by itself, one single stock, had exceeded the entire market capitalization of the Russell 2000. So as I said, the valuation of Apple was larger than Alexander and Baldwin, Allegiant Travel, Boise Cascade, Boys Gaming, Brunswick, Caesars, Cheesecake Factory, Coca-Cola Bottling, Denny's Corp, Hecla Mining, and 1,998 more similar companies combined. I mean, that's just total insanity. That's madness. As we went down through that article, we point out that for the first time ever, the dollar value of options traded exceeded the dollar value of stocks trading in several days during August. Got as high as 114% more dollars were traded in options than were traded in stocks, showing you the level of speculation.
Yeah,
that was going on. And one statistic that really stuck out and just I just couldn't believe this when I read it. More than 75% of all those billions were going into options of less than 14 days maturity.
Yeah.
So that level of pure raw speculation makes the frenetic activity of the 1920s look like a peaceful walk through the park. This is just craziness. And I just wanted to point out some of these things because it's important. It's important that
what people are paying for IPOs and there's all kinds of frothy things out there, Don. So I do remember a tweet. It may have been a tweet or maybe a DM to me where you thought that the S&P before it peaks could trade up to 3,900. Are you still in that camp?
Yes, I'm still in that camp. I'm looking for somewhere around 3,950 plus or minus maybe 100 points. Well, more like 4,000 plus or minus 100 points. by about April. So mostly we're bullish. And the whole point of what I'm talking about today, I guess our time is running out here, so I'll get through it quickly, is I'm not trying to warn people about what they're doing on the long side of the market. I'm trying to warn people to don't lose the mindset of realizing where we are in the big picture. Because this is no ordinary top. We believe that this will prove to be one for the ages. And that's really everything that I wanted to talk about today.
Okay, Don. All right. So, yeah, we have so many things saying that, this is frothy and speculative. And are you going to wait for some type of technical signal? Like,
definitely.
Yeah. So what I'd like then, Don, is when you're seeing it, to let me know, and we'll get you on.
Good.
We'll get you on when you're seeing it again. And do you think we could hold the whole thing could hold together till April?
Yes, I do. Yes, I do.
Is that based on cycles? What kind of cycle?
Well, first of all, I've been following the Fibonacci, the Fibonacci work of Dr. Teixeira. I don't know if you're familiar with him in Investors Intelligence, and he's been showing that the cycles indicate a peak around April. In that area. So
because I know others that have said the same that do cycle work. So, Mark Newton talked about it. And I think the foundation of cycle guys, Andy Patoli, a lot of people pointing towards this April timeframe. If the market's rallying into that zone, that could be it. So,
right.
And now more importantly, we have Don Meade talking about the same thing. So, guys, write it down. Be aware of April, not the Ides of March, but we'll see what's happening. By then, we should begin vaccinations, and everyone will think everything's okay.
Exactly.
And things are getting better, and the market may have already priced in nirvana, which it's currently doing, right?
Exactly. It's,
all right. Well,
that's my main point, is that people need to be mentally ready for what's coming. And the last thing in the world they want to do is adopt the old saw that this time.
It's different this time.
Because that is a killer in the market. And that's my main point today.
All right. Well, Don, I respect your work. I appreciate you coming in during the holiday season, and wish you and your loved ones a great 2021. And when we're approaching the zone and the time, please reach out and we'll get you back in here on F.A.C.E. What do you say?
Thank you very, very much, Dale. I sure appreciate it. And I hope you and your loved ones stay safe and well. And
thank you, Don.
Look forward to the next time we meet.
Okay. And this is my trading warrior brother, Don Meade, and you could follow him on Twitter at 7 Sentinels. And Don is an intelligence gatherer, as you can tell. He looks around for people whose work he respects and gives credit to them, but it, kind of curates things for you guys to look at on his website. So thanks again, Don.
You betcha. And just a reminder, if you go to Twitter, you can see a link to everything we talked about today.
All right, my friend. Happy New Year.
Be well. Stay safe.
Okay, everyone, that's a wrap. We'll see everyone for Turnaround Tuesday. Okay, you're welcome. People thanking you, Don. And remember, don't just count your shares and your IPOs, count your blessings, and we'll see everyone tomorrow. Adios.
Bye.
Bye-bye, Don.